Welcome to the sixth and final part of 2, the technical analysis. So in this final part, we're really going to put some of these ideas together and look at a topic that's called top-down analysis, or the top-down approach. So you may have heard me mention a few times as we've gone through the course about how you should always look at the higher time frames and go down. So of course, when we did the candlestick part last time, we were thinking about the fact that you could have a hammer candle on the daily, and if that's a daily candle, that's made up of 24 smaller candles. And then you can go down and look at the price action on that smaller time frame and see if that lines up with your bias on the higher time frame. So we're going to look at those sorts of ideas now and how you can sort of like use the technical tools we've looked at, the support ideas, the channels, ranges, all those things, and implement them all together in a top-down approach. So to begin with, what do I mean by the top-down approach in a bit more detail? So when you analyze the chart, you always have to start higher, because let's say you start on a 1 minute time frame and you see the 1 minute time frame going upwards. So you think, great, it's a bullish trend. I should definitely be looking for buy opportunities. And what you don't know is that on the 1 hour trend, obviously the 1 minute's like an extreme example, but let's say you go to the 30-minute chart and actually it's a 30-minute downtrend. So when you're looking at the 1 minute trend going upwards, you're actually in a B retracement of a higher time frame down wave. So when you're looking for buying opportunities, maybe on the higher time frame, you realize that actually now is when this B might stop and the C might begin. So you're sort of like confusing the direction you should be going in because you're not taking into account all of those time frames. Whereas if you start from the higher time frames, a bit of a realistic example, let's say that you start from the daily chart and you see that yesterday was a massive shooting star candle, which was a really bearish candle. And you then go down to the lower time frames and you see that you're breaking through support on a 1 hour time frame and you're coming back in to retest it. It might be a good time to go short because you have a reason to do so on a higher time frame. But let's say you were to take that same idea as you're retesting that broken support as resistance on, let's say, a 15-minute chart. It may look like an uptrend and you're looking to buy, but it's like the worst possible time to buy. So that's why we always have to do our analysis from a top-down approach, starting higher and going gradually lower to get that finer picture of the price action to really understand what's happening. Now, charts can go down to a 1 second candle or even a tick chart. So a tick chart is every single time an order is placed, the market will move. But of course, like I said, with a minute chart, that's a bit of an extreme example. You're not going to be doing that. So when we think about top down, we're not literally going from the highest possible to the lowest possible. You're going to be going from what you use in your strategy. Most people look at weekly, daily, 4 hour, 1 hour. Some people may go slightly lower or have some kind of custom time frame in between, like 8 hour or 3 day, but you'll find that's the average one. So those are the examples I'm going to use during this presentation. So let's say we start on the weekly time frame and then you go down to the daily. So of course, on the weekly chart, each candle will be made of 5 daily candles because of course, yes, there's 7 days in a week, but there's 5 days in a trading week. So 10 p.m. on a Sunday evening until 10 p.m. on a Friday evening. GMT, that's when it opens and closes, so just 5 days. Weekends, there's no candles. Daily, you go down to a 4 hour chart. 4 hour chart, you go down to a 1 hour chart. So you're starting from the higher time frames and you're looking down and down and down and seeing how each of those time frames will line up with each other, whether it supports your idea or not. So why not go bottom up then? Why not start from the hourly chart and then go to 4 hour, then to daily? So we sort of touched on this already, but in any investment you're doing, if you're a stock investor, if you invest in crypto, you need to understand the macro picture, meaning like the overall picture, before you start delving into the micro. So if you're looking at a stock, you need to know sort of what direction that stock has been heading in. Because if you just look at it on a day trading time frame and you see that, again, let's say that the 1 hour chart is trending downwards and you think, I'm not going to buy this stock because it's going down today, when actually it's been going up pretty consistently for the last 5 years. You see what I mean? So if you start on the lower time frame and you get that idea in your head, you're actually disregarding the overall macro picture. So when it comes to FX, it's the same idea. You might look at euro dollar and think, it's looking really good for a sell today. It's broken through some support on the 1 hour chart, coming back into resistance, looks like a great sell. But actually on a higher time frame on a daily, it's closed yesterday as a massive hammer through support. So maybe it's not a great idea to sell today because there could be a lot of buying pressure coming into the market. So it's that sort of idea where you start low and you go higher, you get a much worse understanding than if you start higher and go lower. So yeah, that's the idea there. So of course, getting that worse idea, if you just stay on one, you can be trading against the prevailing trend without realizing it, and a variety of other mistakes. So let's imagine we start off on the weekly, and of course we go to the daily, the 4 hour, and the 1 hour. So let's say that the weekly is really, really bullish, right? So it's in a bullish uptrend. Could be making ABCs. You could just be making multiple really, strong bullish candles over and over again. So it's just going pretty much up. You then go to the daily. Daily is also looking bullish. Maybe it's just broken through resistance, come down to retest, formed a bullish engulfing yesterday. So the weekly is bullish, the daily is bullish. You go to the 4 hour chart. It's a bit neutral. It's kind of like ranging just after it moved away. So of course, if the daily forms a shooting star, maybe that was yesterday, maybe today it's sort of like a spinning top, or it's a doji candle. So on the 4 hour chart, that's going to look like a range. So it's kind of neutral. There's no real idea. You go to the hourly chart and it starts to look bearish. You sort of have like really bearish looking candles, or it's going ABC to the downside, but within a range. So if you only looked at the 1 hour chart, you might think, right, you've got bearish ABCs. I'm going to try and get short when it comes back and retests the trend line and the MA or whatever you're going to use. Well, actually, you're trading against what all of the higher time frames are saying. So maybe that's just happening because the market's consolidating and it's not really going in any direction at all. Whereas you really should be waiting and looking for buy opportunities because the higher time frames are presenting you with that idea. Markets are fractal. So the idea here is that what happens on a higher time frame also happens on a lower time frame and vice versa. So patterns within patterns within patterns. So here you can see you've got a few different kind of squiggly lines, but these are our ABCs. So the black line here is our daily uptrend. So you have the initial A momentum, the B pullback correction, and then you get the C continuation, that next momentum leg to the upside. So within these legs, on a lower time frame, you will have other ABCs creating the legs. So it's a pattern within a pattern, it's ABCs within ABCs. So within the B of that daily uptrend, so of course it's a pullback, but it's still an uptrend overall, you will have a 1 hour downtrend perhaps, because on the lower time frame, of course you're looking at a lesser span of time, but the market may be trending downwards, whereas on the higher time frame it's trending upwards. So of course you have two kind of like trends that are moving against each other, but it makes sense because it's just within the overall trend. You don't just go up forever. You have to pull back and correct sometimes. So the 1 hour downtrend out on the B of the daily, that could be ABCs to the downside on a 1 hour chart. And if you literally keep going and going and going. So on the B pullbacks of the 1 hour trend, so obviously the little up movements on the 1 hour downtrend, you may get bullish ABCs on a 15-minute chart or a 10-minute or a 5-minute chart, because it's just a fractal of what happened previously. And if you went to the extreme and said, well, let's look at a 1 minute chart, well, on the B and C and A's of the 15-minute, you're going to get ABCs on the 1 minute. So that's what fractal markets mean, that patterns exist within patterns. And the same idea is true of candles. Candles exist within candles. So a one day of price action, so one daily candle, is consisted of 24 1-hour candles. And that's fractal because then those 1 hour candles are consisted of a number of like 61 minute candles that are consisted of 1 second candles, etc., and then tick charts up to that. So the entire market is like this. Hence why you have to go top down. Because when you think about it, when I said before that you may be looking at that 1 hour downtrend as A, B, C to the downside and thinking, right, I should be looking for short opportunities. And when you get to the bottom of that C, let's say that where the arrow is pointing on that final C leg to the downside, before the daily C occurs, you're looking for a pullback to get short. Whereas maybe that's just come into a big level of support where that bounces away. So you're trying to short the market, so selling the market into a massive level of support where the daily might be getting ready to go for its C. And you know, so on and so forth. If you're looking at the 15-minute ones too. So that's the idea of the fractal market. It's a very powerful idea and something that you really do need to grasp before you go ahead and actually place any trades. So you can use the tools that we've already learned in this context now and not get stuck on lower timeframes. So let's actually do an example here, starting from the top. So ABC, so a couple of examples, then real chart examples, you approach a level of resistance. So of course you may wait to see what price does here, and then you put in a huge shooting star candle. And let's call this a daily time frame or a weekly time frame. So you put in a big shooting star candle, and the candle after that, so the next day or the next week, is another really strong bearish momentum candle. Could be a Mariposa or just a generic down candle. Clearly, the higher time frame here is looking kind of bearish because you've had a big move away from resistance, and it's not sort of, had that little move away and just stayed there for a bit. It's really pushed away hard. That's a strong level of resistance, lots of supply, a lot of selling occurring as you approach that zone and away from it. Now what you do is you think, well, where are we right now? So you have pushed away. Okay, that's fine. You've already done that move. It's sort of been there and done that. And you're now sitting directly where a previous high is. And there may be previous highs before that or previous lows from a long time ago. So it could be a pretty decent sized level. So this is what the higher time frame chart looks like. You have, it could be the weekly or the daily or whatever. You have a strong shooting star, a very strong continuation, and you've now closed that higher time frame candle right at support. So yes, it looks bearish, but maybe this is where it turns away back to the upside again. That could happen. A million things can happen. So that's what we're looking at, is that sort of area. So we want to consider this when we go to the lower time frame. So you come down to the next one. Let's say it's a 4-hour or 1-hour chart, and you see this. So what this is going to be is the lower time frame candle formations within that candle. So imagine that this is multiple candles up and down. Well, all of those candles are going to be within that second red candle. So you imagine as that candle goes down on the lower time frame fractally, you will have ABCs and various wave movements within that candle. So if there's 24 candles within that day, or 5 within the week, that's going to be made up of these ones here. So the market's making this sort of pattern, and you have a level of support there, which we know from the higher time frame is quite a significant level. It's a previous daily swing point at the high. So you're now hitting this support again and again and again. So what might you want to do? Well, if you know the higher time frames are quite bearish, and when you've approached the support level, you've not bounced away super strong and carried on going, you sort of keep coming down and hitting that support again and again and again. Might break through soon. That's kind of an idea that might happen. So let's say that's the daily structure, or it's the 1-hour structure, or whatever is lower than the previous one. Then this will give you an idea as to what may happen. So you're focusing now on the current price action. And if we go down again, so focusing on that area of the chart. So we're going fractal once again. Maybe we're going to the 1-hour chart. The initial was the weekly, or we're going to the 50-minute chart or something. We're just going down. And this is the price action within that little bit of price action. So you've got a couple of lows within just the one low from previously. But as we know, that level's strong. There's multiple lows before that too. And let's say now this happens. You break down through. Well, is there a reason for you to go short as you possibly approach that level again? So flipping from support to resistance, remember part 1. Well, there is, because you have a higher time frame reason to do so. So if you saw this on its own and you didn't know what the context was of the higher time frame, then maybe you would need to check that. But you know the higher time frame is quite bearish. You've got a massive rejection from a really big level. All the candles are nice and red. It's all looking pretty bad. You're now breaking through another level to the downside. Looks like that trend has reversed its structure. So gone from bullish to bearish. So you may look to go short, which is selling, as you come back into that level again. So let's have an example of this on the real chart and sort of break that down. So here's your weekly time frame here, and let's focus on what's happened last week. So obviously the candle that you can see on the right is where we currently are, because it's still open. So last week, if you can remember what that candle is called from the last part, it's a hammer. So you have a bullish hammer, really strong bullish close, and you can see that it sort of does come from a level too. If you look left, you can see some previous highs and lows. So you've got quite a strong weekly reaction from a level. So the price is pushed lower during that weekly session, but closed all the way back up above where it started with a nice strong close. Small little wick at the top, but nothing really important there. Just a nice weekly bullish hammer candle. So it could give momentum to this week, because we've already had the downwards movement and it's already come back. So we've sort of already had that big test into support. Therefore, this week could be the spring, so to speak. So it actually continues that momentum going. But obviously, you don't have to just blindly buy it. You might want to wait for more confirmation on a lower time frame, depending on how you want to trade. So then we come down to the daily chart. What do we see? Well, you can see how the wave structure is changing possibly, because you've had A, B, C to the downside before. So of course, when the market was dropping, as it was coming down and forming those downwards candles and the wick of the hammer, it was making smaller time frame ABCs, fractal ABCs. And now what's happened is you've gone quite strong from the low, and you start to range and sort of form a potential higher low. So you can look on the right hand side there where you have that potential AB that could then maybe be a C. So you might think, well, all right, so the weekly is looking pretty bullish. You've had a hammer last week. You could even see that yesterday, because remember these are daily candles, there was another hammer yesterday. And you've almost had like 3 or 4 lows in the same place. Look at all the wicks, how they're closing roughly in the same place. Well, not closing, but the wicks have gone down to roughly the same place. And look left, there's sort of some support resistance there as well, a bit rough, but there is. And you keep bouncing back higher again. So it's clearly, there's a lot of buying occurring, but it's just accumulating. It's still going sideways because there's not been really much of a move in like 5 days, about a week now. So maybe you want to think, right, well, it's still not really moving, but it's still looking kind of bullish. So if I do want to catch the C, maybe I can go down to a 1 hour chart or lower time from a 4 hour chart, whatever, and see if there's a level that might break before I actually get to that. So you have a series of ABCs you can actually see and a potential transition to a bullish ABC. So you want to try and catch that C. 4 hour chart, you have a few things going on here now. So if you look first at the trend line, so the trend line has broken up through very messily, but you can see how it's not really acting as anything now. So whereas the trend line was really acting as quite accurate resistance previously, you can see the 3 and 4 highs there. Now the market's just chopping through it. It almost doesn't care anymore. So it's almost like that area of resistance is now just being chopped through and isn't really resistance anymore. It's almost being, acting as support now in a way. Same thing with the 4 hour 50, the 50 EMA. So look from the very left-hand side, it was support, then flipped to resistance on the way down, and now it's acting as support, and it's sort of going sideways. So remember I said that one of the many uses of moving averages is trend direction. And when you have the market moving sideways like this in a range and consolidation, the MA will often do the same thing. And you can see the MA is not up or down, it's just sideways. So it's showing you that now is consolidation, whereas previously it was going down quite well. So now this could be when it starts to flip around to the upside. So what might you want to wait and see? Well, box off that range. If you get a nice A momentum leg to the upside, maybe then you wait for a B and try and buy back into what was resistance, may now be support. And try and catch that higher time frame flippening of the trend, but waiting for confirmation on the lower time frame. So that could be something that you'd want to check to do. So that is top-down analysis in a nutshell. I mean, you start from the higher time frame, you go lower and lower and lower, and you sort of gain the understanding of what you may be looking to do with a reason, so with context. Whereas just looking at the 1 hour chart and sticking on the 1 hour chart and nothing else is not going to help you very much in your trading. You won't perform very well at all. So that's actually all of chapter 2. That's the final part of chapter 2. So that was all the technical analysis section. And of course, I will see you in chapter 3. And if you do need to go back and recap any of that stuff, I'd highly recommend understanding this fully before you move on to the next chapter. Until then, I will see you in chapter 3.